I know that you want to be a better investor. My name is Michael Santos. I want to help you get there, and we're going to do that by continuing this case study on Michael's Hot Dogs. It is a corporation that I formed for the purposes of simply illustrating how do you become a good investor. And I'm sharing the strategies that I used when I got out of prison after 26 years to work towards acquiring my first $1 million in equity and multi-millions of dollars in assets. All of that happened because I understood business. So I'm using Michael's Hot Dogs, a fictitious business case study, and you can look at the earlier videos in this playlist to learn a little bit more about how we got there. The quick summary is I formed a corporation. I divided that corporation into 1,500 shares of stock that we raised capital through a combination of equity and debt, a total of 500 shares in equity that I sold for $1 a share. I raised $250 in debt from an investor by paying him a 10% interest-only loan, or agreeing to pay him a 10% interest-only loan. So now our business, Michael's Hot Dogs, is fully funded. It is an organization that currently has $750 in debt. It has, $750 in cash in the bank. And what I'd like to do with you now is talk about how are we going to execute this business plan that we created to turn that $750 in cash that's in the bank. It belongs to the corporation. It came from our equity shareholder and the person who lent us the money. How are we going to turn that into a business? And how are we going to account for it all? Well, that's what we're going to be talking about right now as we move into this section where we discuss financial statements and how we account for things. And I want to give a debt of gratitude personally to a very well-known hedge fund manager, Bill Ackman, who taught this course earlier, and I learned a lot. Didn't teach, of course, about Michael's Hot Dogs, but he was teaching a course on business, and I thought this would be a great way for me to use some of my experience and reveal it to people who might be in struggle that want to get into business, or people who are young, who have never been involved in business before and are making some very serious decisions with regard to taking on student loan debt so they could go to college. I'm a big believer in we have to think differently, we have to think critically, and we have to think about what can we do with all of our resources to make the best possible decisions that will take us from where we are today to where we want to go in the future. And the courses that you will find on michaelsantos.com really help you get there. And I really believe that to become a good investor, you have to have some knowledge about business and how businesses operate. I've just given you the information of Michael's Hot Dogs of how we got to where we are, which is having a little bit of cash in the bank, but that cash in the bank doesn't make a business. We have got to begin sowing seeds to grow that business, and we also need to keep very detailed accountability metrics that will help us determine where we are, and that's what a financial statement does. Right now, since the only thing we have done is raised capital, we have to start our financial statement with a document that is called a balance sheet. Later, once we start operating, we'll also create an income statement, also known as a profit and loss. And together, the balance sheet and the income statement, as well as perhaps a cash flow report, give us a sense of how the business is performing. But let's start with a recap of what the balance sheet would look like for Michael's Hot Dogs. Let's take a look at the balance sheet and see what we have. That balance sheet is going to tell us what our assets are, what our liabilities are, what the net worth of the business is, or rather, what is the shareholder equity. And we get that by subtracting liabilities from assets. So let's talk about the balance sheet right now. What does the asset column of Michael's Hot Dogs look like right now? I can tell you it's pretty simple. We have cash. We have a cash account, right, of $750. Okay? That is the asset of our corporation. We have a $750 in a cash account. But let's remember where that cash came from. We received $500 from an investor that purchased 500 shares of our corporation at $1 a share. But we also received $250 in the form of debt from a loan to the corporation, and that's what makes up our $750 in cash. So that's what is in our current cash account. But we also have something else, because remember that there were 1,500 shares in the corporation. 500 shares belonged to the investor who put up $500, but also I kept 1,000 shares of the corporation, and so we're going to record that also under the asset column as goodwill. That's what it's going to look like on the balance sheet. And what we have there is $1,000. Why $1,000? Well, it's quite simple. We knew that an investor bought 500 shares for $1 a share. I kept 1,000 shares. It's equal to the same level as the investor did. So together, we've got total assets in the corporation of $1,750. Okay? Those are our total assets as of right now. But that's not all. We also have a liability in the corporation, because remember, we borrowed $250. And that $250, it's an asset in there, but we also owe debt. So we have to record another segment on our balance sheet, and we're going to call that liabilities. This is like a report card for business. And if you want to be an investor, it's really important for you to understand this report card, because you have to know where you stand at all times. Okay? Our liabilities at this stage are what? $250. And we can put parentheses around that because we owe that money to somebody else. He's not a shareholder of the corporation, but we could still call him a stakeholder in the corporation. Okay? That $250 is guaranteed by all of the assets of the business. So at this stage, he's in pretty good shape. He's got $750 in the bank, that pretty much secures his $250. So the balance sheet right now shows us the total equity in the company by doing a very simple formula. And that formula is we subtract all of the company's liabilities from all of the company's assets, and that helps us see what is the net worth or shareholder equity of the corporation. Well, we know that if we take that out, we've got $1,500 in shareholder equity. Okay? That's what the business on paper, on the balance sheet, is worth right now. Okay? $1,500. In the case of our business, that's what our balance sheet shows. That's what we would show to somebody else. We have $1,750 in total assets. We have $250 in debt. We have a total value of $1,500. And we know that we have 1,500 shares, so every share is worth $1 a share. Can you see how all of that balances? Hence, we call it a balance sheet, right? Every share is worth $1. So this concept is going to help you if you become an investor, regardless of what type of asset class you build. Regardless of what asset class you build, you are going to want to know, how does this look on paper? And one of the responsibilities I have as an investor is to track my investment all the time, every single day. But remember, a balance sheet is only one piece of the equation. It shows us how we look today at a given state in time. But this isn't the way it's going to stay. I'm the founder of the company. I have a duty and a responsibility to increase shareholder value. That's my job. And I can't do that by leaving my cash in the bank. I've got to make good business decisions to launch this business. And so we are going to look and see, how does this asset allocation shift as I start building the company? That's my job, to build the company. That's why an investor believed in me. That's why a debt holder agreed to lend me money, because the plan showed that I was actually going to build a business. So I'm going to invest our $750 in cash into other types of assets in order to build this business. So we can do that by continuing the work of seeing how this balance sheet evolves and grows. Okay? We started with $750 in cash, but watch what I'm going to have to do. The first thing I'm going to have to do is to invest in buying a hot dog stand. And we're going to say that hot dog stand is going to cost us $300. So now look at how our assets change. Okay? We've got assets here of cash, but I know that I'm going to need a couple of things. I'm going to need some fixed assets. This is a current asset, right? I'm also going to need to buy a fixed asset, and that's going to be a hot dog stand, right? And I'm spending $300 for that. Okay? In addition to the hot dog stand, I'm also going to need something else. It's not a fixed asset, but I'm going to need to buy some materials, some inventory. I'm going to need some hot dogs. I'm going to need some hot dog buns. I'm going to need some napkins. I'm going to need some condiments, right? So that's our inventory. And let's say that I'm going to need to spend $200 in inventory. So now I've depleted my assets, my cash assets, because I just spent $500. So 500 from 750, we know that we're going to have still $250 here in cash that we're going to keep on reserve. Okay, we've got a hot dog stand, which is fixed income. We've got inventory of $200. So our total assets still stand, actually $750 plus, that's not the total assets, that's these assets, plus I have the goodwill of $1,000, right? Goodwill. Then I have liabilities. That hasn't changed. I still owe $250. So at the end of the day, we are still going to have a net worth on our balance sheet of total assets $1,750. We're going to have total assets of $1,750. We're going to have liabilities of $250, and that's how we get our shareholder equity, which remains at $1,500. Okay? That's how a balance sheet changes in time, because we have shifted our asset allocation. Now we have cash, but we also have a fixed asset of $300, and we also have inventory of $200, and this is what we are going to use to get our business started. Now it's important to understand this fixed asset of $300, because it's not going to last forever. We have got to understand that a fixed asset like a hot dog stand has a useful life. We're going to record it at, say, 5 years. That means I'm going to have to depreciate this asset every single year for the purposes of making sure I have enough money in the bank at the end of 5 years to replace this hot dog stand. So I just very simply take a useful life here of 5 years, and I divide that, and that gives me, I know that that's going to show up as a non-cash expense on the income statement for $60. 300 divided by 5. Every year, I'm going to depreciate it by $60. Then after 5 years, I still have that enough money in the bank to take care of replacing this fixed asset so that I can keep my business going. So this is one component of a financial statement, the balance sheet. And this is what the Michael's Hot Dog Stand's balance sheet looks like after I've made my initial operations. But I haven't done anything yet. All I have done is get my business ready to roll. I started with $750 in cash. Now I have $250 in cash. I've got some fixed assets. I have got my goodwill remaining. My liabilities remain the same, but I haven't made any money. The business hasn't made any money. In fact, I've really made it less valuable in the moment. This is just a paper look of what the business looks like today. What's important for me to do right now is to go start making some money. It's to go and start turning this whole business model into a business that generates income. And we are going to record that information on the other form of the financial statement, which is the income statement, the profit and loss. But I don't want to get into that now because this video has already gotten a little bit long. So I'm going to continue with the financial statement and then using the financial statement to assess performance in the next video. But one cardinal rule I want to leave everybody with right now is what this asset is worth. On paper, it may be worth $1,500, but at the end of the day, this is just a paper balance sheet. An asset, all these assets are only worth what the next person is willing to pay for it. We have to begin working on our business plan to build shareholder value. And that's what we're going to talk about in the next video. And that's where we will introduce you to the P&L, the income statement, the heart of any business. My name is Michael Santos. If you are learning anything from these programs on understanding investing, please subscribe to the channel and come back because I'm producing content all the time to help you become a better investor.